In the early 2000s, owning a home wasn't just a goal, it was the dream. Banks made it incredibly easy to buy one. Interest rates were low, approvals were fast, checks were minimal. You didn't need perfect credit. You didn't even need a stable income. As long as you could sign the papers, you could own a house. And people rushed in. Homes were being bought faster than they could be built. Prices kept rising, and everyone felt richer because most people believed one simple idea: house prices would never go down. So buying a home wasn't just about living anymore, it became an investment. People started buying second homes, even third homes. Some bought houses just to resell them quickly for profit. Banks were happy to keep lending because every loan meant more money for them. Everything looked perfect on the surface, but behind this booming housing dream, a dangerous problem was quietly growing. Here's where things get risky. Subprime loans were given to people who normally shouldn't qualify. People with low income, poor credit, unstable jobs, but banks didn't care because they weren't planning to keep these loans. Instead, they'd package them. Thousands of risky mortgages were bundled together and sold to investors. These were called mortgage-backed securities. On paper, they looked safe, but there was a problem. Many loans started with low payments, then suddenly increased. When that happened, people couldn't afford them anymore, and the system began to crack. Pattern interrupt. At the peak, over $600 trillion were tied to these risky financial products. Then the cracks became impossible to ignore. Homeowners began missing payments, defaults increased, and suddenly those safe investments weren't safe anymore. House prices stopped rising. Then they fell. People owed more than their homes were worth. They walked away. Foreclosures exploded. Then came the breaking point. Lehman Brothers collapsed. A massive bank gone overnight. The financial system froze. Banks stopped trusting each other. The crisis had begun. Jobs lost. What followed was chaos. Families lost homes. Savings disappeared. Entire communities collapsed. And it didn't stop in one country. The crisis spread across the world. Markets crashed, economies shrank. Governments stepped in to save the banks, but many ordinary people were left behind. Trust was broken. Global losses were estimated at over $10 trillion. The 2008 financial crisis wasn't just about money. It was about belief, greed, ignoring risk. Because sometimes the most dangerous bombs don't tick loudly, they sit quietly until it's too late. What a great lessons learned in today's documentary. Please subscribe for more financial dark files. See you next time.